Central banks do not buy gold because they are nostalgic. They buy gold when trust becomes expensive. Publicly, the modern monetary system speaks the language of confidence. Stable currencies, managed inflation, independent policy, deep bond markets, and institutional credibility. But quietly, the same institutions responsible for paper currency are increasing exposure to an asset with no issuer, no counterparty, and no political promise attached to it. Since 2022, central bank gold demand has stayed historically elevated, with purchases above 1,000 tons annually in 2022, 2023, and 2024. That is not random portfolio decoration, that is balance sheet behavior. The public hears inflation is under control. The balance sheet says, we want reserves outside someone else's liability. And that difference matters because gold is not bought for yield, it is bought for settlement. It is bought when the credibility of debt-based reserves becomes a strategic question. A central bank holds reserves to defend confidence. Those reserves are usually made of foreign currency, government bonds, and gold. Foreign currency is liquid, but it depends on the issuer. Government bonds pay yield, but they carry duration risk, inflation risk, and political risk. Gold pays nothing, but it also promises nothing. That is precisely why it matters. In a fiat system, money is created through credit expansion. Governments issue debt. Central banks influence interest rates. Commercial banks extend credit. Liquidity expands through balance sheets before it reaches wages. This creates a structural advantage for institutions closest to new liquidity. That is the Cantillon effect in practice. Asset holders reprice first, wage earners adjust later. The cost is not always visible as a direct tax. It appears through purchasing power erosion, higher asset prices, lower real savings yield, and increased dependence on financial markets. In 1971, President Richard Nixon suspended dollar convertibility into gold through the new economic policy. The structural consequence was the end of the Bretton Woods gold anchor and the beginning of a fully floating dollar reserve system. That decision did not destroy the dollar, it changed the discipline mechanism. Instead of foreign governments redeeming dollars for gold, confidence had to be managed through treasury depth, military power, trade settlement, and central bank credibility. In 2008, under Federal Reserve Chair Ben Bernanke, the Fed expanded emergency liquidity facilities and began large-scale asset purchases. Those purchases included agency debt and mortgage-backed securities. The consequence was a larger central bank balance sheet and a new monetary era. In that era, asset prices became more directly linked to central bank liquidity. Again, the incentive was understandable. During crisis, the system protects liquidity first. But the cost is transferred over time. When money is protected through expansion, the unit of account becomes less scarce. That is why central banks buying gold is not contradiction. It is institutional hedging against the very system they administer. The financial consequence is simple. When confidence must be managed, neutral collateral becomes more valuable. This pattern is not new. When monetary systems become overstretched, reserve assets begin to shift before public narratives change. In the late Bretton Woods period, foreign dollar claims grew faster than the gold backing available at the fixed conversion rate. The problem was not merely political, it was mathematical. Too many claims existed against too little hard settlement. Nixon's 1971 decision acknowledged a structural reality that already existed. The dollar could not remain both globally abundant and strictly redeemable at the old gold price. A second echo appeared after 2008. The financial system discovered that safe assets were safe only as long as liquidity remained available. Mortgage securities, bank balance sheets, repo markets, and sovereign bonds all became dependent on central bank intervention. Bernanke's crisis response stabilized markets, but it also normalized the idea that central banks could use balance sheets as policy instruments. A third echo appeared during the inflation cycle after 2020. When fiscal expansion, supply shocks, and monetary accommodation collided, real purchasing power fell before many institutions admitted the scale of the problem. Jerome Powell later defended the Fed's balance sheet tools, and in 2025 said the end of quantitative tightening might be approaching. The structural consequence was clear. Even balance sheet reduction has limits when markets are built around abundant reserves. This suggests a modern parallel. gold is not replacing fiat money in daily commerce. It is being accumulated as reserve insurance against excessive dependence on fiat liabilities. When central banks buy gold, they are not making a retail investment decision. They are adjusting reserve composition. That matters because reserves are not about performance. They are about survivability. The first observable pattern is diversification away from single currency dependence. After sanctions, geopolitical fragmentation, and rising sovereign debt burdens, many countries began treating reserves as strategic infrastructure, not just financial assets. Gold sits outside the banking system. It cannot be printed by another central bank. It cannot be defaulted on by a treasury. And it cannot be frozen in the same way as a bond held through custodial channels. The second observable pattern is debt credibility pressure. When governments run persistent deficits, they must roll debt continuously. If real rates rise too much, debt service becomes painful. If rates are suppressed too long, purchasing power weakens. Either path creates tension. Gold benefits from that tension because it represents no one's promise. The third pattern is asset repricing. When official institutions absorb physical gold supply, they remove liquidity from the market. This does not guarantee price direction in a straight line, but structurally, persistent central bank demand changes the floor of strategic demand. The fourth pattern is a quiet shift in time preference. Paper systems reward short-term liquidity. Gold reflects long-duration distrust. Not emotional distrust, institutional distrust, the kind that says, we still use the system, but we will not be fully dependent on it. For a rational actor, the implication is not to copy central banks blindly. The implication is to understand what they are signaling. If the institutions closest to fiat mechanics want neutral reserves, then individuals should at least question whether their entire financial life should depend on currency, banks, platforms, and policies they do not control. This is where Bitcoin enters the analysis carefully. Bitcoin is not gold. It has different volatility, different infrastructure, different custody demands, and a shorter history. But structurally, it shares one critical property. It is monetary infrastructure without discretionary issuance. Gold is physical neutrality. Bitcoin is digital scarcity. Both challenge the assumption that every form of money must be someone else's liability. Central banks are not buying gold because they expect the world to end. They are buying gold because systems built on debt require credibility, and credibility becomes harder to maintain when debt expands faster than productive capacity. That is the sober reading. No drama, no conspiracy, just incentives. A fiat system needs elasticity. Gold provides discipline. Governments prefer flexibility. Reserves require trust. Markets want yield. Sovereigns want optionality. The mistake is thinking these forces are separate. They are one machine. When central banks speak, they defend confidence. When central banks buy gold, they manage risk. Both can be true. The disciplined observer does not react emotionally to this. He studies the structure. He asks what assets depend on trust, what assets depend on liquidity, what assets depend on policy, and what assets remain functional when promises are repriced. That is stewardship, not fear, not rebellion, responsibility. Because your financial life is also a balance sheet, and every balance sheet reveals what its owner truly believes. This is 21 Protocol. Freedom is not a feeling, it's a structure.